Most investors like buying blue chip stocks in their portfolio, and a classic example of a blue chip stock are bank stocks. Now in Malaysia, there is no comparison. The largest of them all is Maybank, and why most investors love them is because they pay good dividends, is highly regulated, and there's backstop by the government. But in this video, I'm going to show you a contrarian view and why bank stocks aren't what they seem on the surface, and why I personally don't put my money into banks. Hello everyone and welcome to the channel. My name is John, former engineer turned full-time investor, currently wealth planning director at Phillip Capital and author of the book Malaysian Multi-Baggers, where I cover companies that have 10 to at least 100 times shareholder returns within the Malaysian market. Here's two headlines I want you to consider. January 2022, Anwar demands MOF explain why Maybank, CIMB, RHB gave Genting Hong Kong a 2.5 billion unsecured loan. Unsecured is the keyword, right? When you buy a bank stock, you're actually investing in a financial black box. Now, why do I say that? It's because you have absolutely no control on how the bank actually underwrites the risk, or in layman terms, how does the bank actually loan money to entities or people. I have to give you first the concept of a balance sheet. Now, for those of you unfamiliar with the financial statements, there's three parts of a financial statement, which is the income statement, the cash flow statement, as well as the balance sheet. On the balance sheet, you will see two main things, which is the assets and the liabilities. And in the case of a bank, the asset, ironically, are loans that people owe them money. Because how do the banks make money? They borrow money to people, and then people owe them money. There's an IOU note somewhere in the balance sheet that says, okay, this guy owes me 2.5 billion in this case, and you have to pay me a certain interest rate, and that is part under the asset of a balance sheet, right? Now, obviously, liabilities will be the reverse, because liabilities on the balance sheet for a bank would be what people, what the banks actually owe people in terms of deposit. So you deposit fixed deposit, or you put into a savings account, into a bank, that's actually liabilities of a bank owing to the people who gave them money. So it's kind of the reverse for most businesses, because if in a manufacturing business or other businesses, liabilities is what people owe them, either their clients, right? And then in terms of assets, it will be like buildings and all that. In a bank, a lot of their assets are actually amounts owing to them by loans that they give out. So here's the problem. When you go to a typical balance sheet of any listed company, most of the time they will be able to like tell you what are the assets on their business. That means factory or land or inventory. And here you will be able to do what you call a due diligence for other sources to say that, okay, if this guy is selling food and he says my inventory is this, but it's a perishable thing, you know that you can put a discount to it, because if it doesn't sell within a certain shelf life period, then there's no value in the asset. Or if it's a land, right, and you know that, okay, this land, they bought it maybe 20 years ago, they bought it, let's say, for 100 million, and then 20 years from now, if it's in a good area, maybe let's say Kajang or Shah Alam or wherever, then you know the land value has actually increased, that the asset value has actually increased. And you contrast that to a bank. Now, a bank, when they start loaning people, there's a certain standard or guidelines. They'll check your credit score, they'll look at the ability of this guy to pay, reputation-wise, they do a due diligence, but they don't detail all of that to you in their annual report, because there's a joke going around. If you want to borrow money, if you go to public bank, they say that if you don't need money and you need to borrow money, then you go to public bank, then they'll give you a loan. But if you are like on the fence and you're like, credit score may not be that good, but then willing to take a slightly higher interest rate, then you go to the other banks and you're likely to get a loan. I mean, the credit scoring or the credit tightness or the underwriting is slightly a little bit more lax. Now, it's an unwritten thing, it's not really documented, but that's exactly the point, because in a bank, the underwriting process differs from bank to bank. Some banks just don't like it risky, very conservative, but at the same time, because they're conservative, they can't loan out, they can't grow their loan book as fast. Whereas the banks are overly aggressive and they are very lax on their credit scoring, they're not very tight in their underwriting process, then you can grow market share, but then your balance sheet is laden with a lot of toxic assets, because these guys may not pay you, and then what happens is that you have to write out a lot of these loans in the future. So this Genting case is an example of how this is a cruise liner. What do Genting Hong Kong actually borrow money for? Is to buy ships, right? And cruise ships. And in a crisis like COVID, who's going to pay you for your cruise ship? Who's going to operate a cruise ship? And in other crises, maybe another virus attack, or maybe high oil prices or high inflationary rate that nobody wants to travel. A lot of these assets now become almost like scrap metal. There's not much value in it. But again, it ties back to the point about banks. It's like, how do you know what are the toxic, unless you go through all the notes within the annual report, and hopefully they disclose and they'll tell you what exactly is this loan for, why did they loan this for, and no bank is going to tell you that. I mean, there's this joke of a very famous hedge fund manager in the UK, and he actually went up to the CEO of Credit Suisse and says, okay, you've got maybe $1 billion on your assets, right? Can you please explain to me every single line item on the assets? And the chairman of this bank actually said, I have no clue. So there again goes to show you, as a retail investor, you cannot see that kind of massive liabilities until it's too late. I mean, even for professional investors, because no bank is going to disclose every single line item on their loan book, because that's their secret sauce, that's their trade secret for how they underwrite loans as well. So yeah, that is one of the main reasons why I don't look at banks. Reason number one. Here's a second headline for you to consider. Sabah Dynamic defaulting on 435 million in Islamic facilities. So Malaysian banks, they operate under this strict nationalistic agenda, and there's a lot of regulatory constraint for them to grow regionally, not because of their own ambition not being hungry enough, but because no country wants a foreign bank to be big within their own country. I mean, if you look at Malaysia as an example, you don't see HSBC or OUOB or OCBC, all these foreign banks having many branches within, or many ATMs within Malaysian vicinities, right? This forces a lot of Malaysian banks to take on more domestic liabilities, and it also creates this kind of comfort cozy zone, because of mergers and acquisitions after the Asian financial crisis. A lot of these mega banks have been created, and they are almost like a right size for Malaysian population, but then they cannibalize each other's market share, and then they have to take on more risk domestically, because you see, Bank Negara actually prevents or protects a lot of these local banks against foreign takeover. But because now of all this consolidation or certain right sizing, there's a cap to how much Malaysian banks can actually grow. I mean, there's this story that I keep on sharing with my investors or potential investors, is that I don't buy Maybank, because if you look at where it is today, they're probably 130 billion market cap. For it to grow to a 500 billion market cap, that means you have to grow earnings roughly about 5 times. And for them to grow earnings 5 times over the next 5 to 10 years, how likely is that scenario going to be? I mean, we are not seeing an increase in population. We're not seeing a substantial increase in purchasing power for our Malaysian workforce. So how are they going to grow just being a domestic or a slight regional champion? So there goes in this concern about and tied back to point 1, which is opaque balance sheet. Therein grows my concern about how big is the addressable market, which is the second reason why I don't invest in banks, because of this regulated nature, because of a cap to how much income can actually grow in a certain country. Then plus you have nationalistic agenda by the government to support local businesses that may not be the best businesses to borrow to or lend to. This actually compounds to this problem that you see in the headlines, that Malaysian banks having to support these businesses, they lack fund flow, deal flow, or loan flow. to be able to grow. And yeah, I think the dome or the cap of how big they can grow is really the second reason why I don't invest in banks. During the Asian financial crisis of 1997, the non-performing loans, that means those loans that had undergone a default, actually jumped all the way to about 15%, 14.9% to be precise. And why this is actually a risk is because most banks are fundamentally very asset heavy, and they're very capital inefficient. Because what is the inventory? The inventory is actually cash. You need to borrow money to lend out money, right? And to grow, you are legally forced by central banks to actually hoard a lot of cash in reserve. And this is actually further compounded after the 2008 global financial crisis, where they came out this regulation called the Basel regulation. You can go read them out. It's too much to cover in this video. Basel 1, 2, and 3. So literally, in essence, what Basel regulation required is that there's a certain capital that banks need to hold as a safety cushion, called the Tier 1 cash capital, before you can actually lend out a certain ratio of it. So virtually you can't be borrowing or lending out $100 if you only have $1, something like that, right? So because of that, you want to grow, you literally have to borrow more. And you contrast that with another business that's capital light, not so asset heavy, and they can do away with a lot of physical infrastructure. Like, you look at digital banks, yes, the sexiness of like not having to have branches and grow through digital distribution is 3 years since the first digital bank license was awarded in Malaysia. Where have they gone to? They've not really scaled, right, as compared to a bank with a physical branch. So contrasting these two, that's why you see, during a crisis, or only during a crisis, all these flaws actually start coming up. And in 1997, if you look at the headline here, there was a certain government agency that was set up in order to absorb a lot of these toxic assets, 52.42 billion to be precise, where Dharna Harta actually had to help strip out a lot of toxic assets at a 55% haircut discount to be able to bail out the government's assets that were housed in GLCs and all these kind of things. So you see, that is the struggle for them to be true compounders. As a bank, all this regulation, all this capping of expansion, and now and actually Basel 1, 2, and 3 for me is actually good for both the banks as well as investors, because now it kind of protects either state funding or either retail investor or institutional money into banks that may own toxic assets that that we and you and I don't know. But at the same time, it also caps that kind of growth, because you need to borrow money to lend out money lah. And I think that is the reality of the banking business model. And that's actually the third reason why I'm not really invested into banks. Not really, I don't invest in banks actually. Let me show you some evidence of what I just conceptualized to you. If you look at the data on the screen right now, Public Bank actually grew its net profits roughly about 6.3% CAGR-wise over the past 5 years. And yet market cap has only grown roughly about 3.4% over the same period of time. Investors actually just refuse to pay premium for what they know of the growth of the banks, which are legally and geographically capped as per the reasons I mentioned earlier. And if you contrast that to maybe a capital light kind of business, they can actually grow their profits by 10%. Rather than being saddled with a lot of loans on the balance sheet to actually lend out money, they can actually, these kind of capital light businesses can actually re-rate much faster, because they can scale globally without matching reserve kind of commitments or constraints. So I think that's what, as an investor, what you're looking for. You're looking to pay for a business that gives you bigger and bigger cash flows in the future, can grow and scale, that they can compound continuously. Whereas the business models of a bank always restricts them from scaling as fast as these capital light businesses. So in essence, what I'm really trying to say is that if you want to invest in banks, it's really a wealth preservation or a hedging tool, similar like if you were to invest into REITs that gives you some kind of a yield. But then if you're looking for wealth creation, banks are definitely shouldn't be within your portfolio. You have to choose where you put your capital wisely, because if your goal is to have safe, slow income to match, or I don't think it even matches inflation, but some people think it is, then local bank dividends are fine. It can give you 5-6% kind of returns. But if your goal is to kind of compound and some kind of an exponential wealth creation, then I think banks shouldn't be in your portfolio. That's my contrarian thought. If you want to know or you want to be part of a journey where we look for growth compounders to park into our portfolio, and these companies can compound for longer periods of time and grow at a scale much larger than banks, check out the links in the description below.